Welcome to the Agent of Wealth podcast with Mark Bautis from Bautis Financial. In this podcast, Mark helps guide you towards financial freedom, ensure you never run out of money, and create a balance in life that prioritizes what is most important to you. Join us for this journey as Mark draws from years of expertise and guest experts to solve the multiple wealth building challenges involved in your financial life.
Welcome back to the Agent of Wealth podcast. This is your co-host, John Williams, and today I'm joined by a special guest, Courtney Moeller. Courtney is an oil and gas investor, entrepreneur, and Navy veteran who helps high-income earners reduce their tax burden and build passive income through alternative investments. Having grown up in Midland, Texas, right in the heart of the oil and gas industry, she brings both generational knowledge and firsthand experience to how energy investing actually works. Courtney focuses on helping investors access opportunities that can potentially offset active income, generate ongoing income streams, and diversify beyond traditional stocks and real estate. Courtney, welcome to the show.
Oh my gosh. Yes, John. Thank you so much for having me. It is such an honor to be a guest.
I'm really excited for our conversation today. We had a chance to chat here a little bit before, and I was expressing to you how much this is such a topic, and not just oil and gas. I think there's a lot of popularity around it right now, too, just because of TV shows. And funny enough, I had a client kind of get involved, and he was like, yeah, I think Landman had a lot to do with my interest in getting. I'm sure you might even be sick of hearing about it because you're in the business, because it's a pretty cool show.
No, it's so cool, and it's where I'm from, and so I was really excited when it launched. And I don't know that there's a day goes by that somebody doesn't bring it up. It happens every day, but it is a great show.
Yeah, probably should have asked you before, because it probably is something that people bring up. But many times clients will come to me, and I call it a good problem to have. They're making too much money. And when it comes to ordinary income, there's very few ways to reduce your ordinary income, especially from the passive investors. But I actually am really interested to quickly just lay some groundwork and just hear to tell our listeners a little bit about you growing up in Midland, Texas, and maybe like how that you feel that potentially shaped your perspective on energy investing today.
Sure. Well, you're right. Everybody does come for the taxes. And it's funny, when I was young or younger or child growing up, I never thought I was going to land in the oil and gas space. But it is something I've been around my whole life. My father was a petroleum engineer. My brother drilled oil. My sister, hauled pipe out to rigs. My uncle has a well servicing company. And even when I was growing up, not only, did we have our roots in Midland, but we lived and my father drilled in the United Arab Emirates, in Pakistan, and then for 20 years in Jakarta before he retired. And so it's something that is really, I would sit around at the dinner time, listening to my brother talk about tripping pipe and moving rigs. And, this has just been a natural part of my life growing up. And so in 2011, when my dad passed away, I inherited his oil and gas company, and we continued drilling with, companies like SM Energy and ConocoPhillips throughout the Permian Basin. So we own a lot of, mineral acres and that sort of thing. And it wasn't until years later that I was actually looking to diversify out of oil and gas and into some other asset classes, because I figured out very quickly that my income was very dependent upon the price of a barrel of oil. Through, that journey, I learned about alternative investments and, how people were buying apartment complexes, and my mind was just, blown, and thought that I was actually going to be, putting deals together to buy real estate, and then figured out that I didn't know what a CapEx was. And there was all these things that I didn't know. And I thought, I'm just going to stick with what I know and what I'm good at. My father spent his entire life, building relationships with companies like Exxon and Shell. And I just thought, I'm going to utilize my relationships and knowledge and bring an asset class to the table that's got really substantial, tax benefits and income potential and things like that. So that's kind of like my life in a very super quick nutshell. And now that's essentially what I do.
Maybe a little bit more, like, I'm just really curious to hear like your experience in the Navy and how that eventually led to, just really quickly, like where it led you to today.
Well, when I was growing up, I feel like everything I do, I've always had kind of shiny object syndrome. And, I could never figure out what I wanted to do when I was going to grow up. And, I tried a lot of different things. And at one point in time, my mom was like, you should join the military. And I thought, what? That's a man's job. I am not going to go do that. And I looked at joining the Air Force and, ended up deciding that the Navy was giving me a much better offer. And so I went in. They wanted me for the nuclear program, and I really wasn't interested in that. But avionics was something that I was. So they offered me avionics, and I had already been going to school for computer operations and maintenance and software. And, I was already interested in that. So it just lined up perfectly. And for those that don't know what avionics is, all of the little, computers and everything in these aircraft, when they would break, they would bring them to my shop to fix. So, I spent all of 2003 in the Persian Gulf for Operation Iraqi Freedom. But I think the Navy, I was young. I really wasn't sure what I wanted to do, but it really kind of gave me discipline and helped me kind of decide on where I wanted to go. And got out, became a realtor, and ended up opening up my own real estate agency, and thought that was what I was going to do forever. When my dad passed away, I did not see myself landing in the oil and gas space, but, obviously inheriting his company opened up some other opportunities. It kind of forced me into learning a lot more of the ins and outs of the business than what I had actually known before. I knew everything from like a drilling perspective, but not from acquisitions and expenses and some of those other things. So it really gave me a well-rounded full picture of what we were dealing with from start to finish. And I really love it. I've learned so much along the way. I wish my dad was still here so we could talk about it, but he's not. I know he'd be really excited.
Yeah, no, thank you so much for sharing that. I'm sure that the discipline part of it and being part of the Navy, I'm sure you have all kinds of stories there, which we'll save for another time. But I wanted to lay some quick groundwork for our listeners into just understanding, and I'd mentioned the complexities of being able to reduce your ordinary income outside of maybe a 401k. There's really three places like that I actually have identified opportunities, and oil and gas being one of them. But I mean, I don't, if I hand it over to you, just kind of like very quickly, like cap gains, the complexity, or like what we're looking at as far as just a high level tax opportunities.
Well, I'll start with a little bit of why. A lot of people don't realize that oil and gas are needed for just about everything. If you're watching Landman, because Tommy, he's done a great job of talking about how it's needed. Every other industry is very dependent, and we need it for everything. Well, the United States government stepped in and said, look, we know it's really risky to drill oil, so we're going to give you these tax incentives to keep you out there drilling because we need it. So it's been around for decades. This is nothing new. It's nothing new that's just come around. It's been in place, I think, going on like 100 years. I don't know the exact time frame, but the tax benefits are so special, and a lot of people don't even realize that they exist. And I would say the first one that most people that are aware of it love are those IDCs, those year one tax benefits. So when you're going to go in and drill a new well, you get the IDCs, which is the intangible drilling costs of drilling a well. And that's like your fuel, labor, things like that. And that has the potential to offset W-2 income, active income, capital gains. So I have a lot of business owners, a lot of people that sell real estate, and they've got this massive, capital gains problem, or they're doctors and they have high income and they're just trying to reduce that. So just by investing in the deal, you get that year one tax benefit if you're drilling new wells. The second one that is also pretty cool is what's called a depletion allowance. And that means that about 15% of the ongoing income is tax-free every year for the life of the wells. So you get that really great, year one tax benefit, and then that ongoing depletion allowance.
Just to give the listeners a little bit, even just more detail into like the potential first year, like what does that look like from a percentage? Like, I put in $100,000 for a round number, and what could that potentially look like in the first year related to ordinary or earned W-2 income?
And that's a really good question, because depending on what deal you're looking at, that number can vary, and it varies based on where your invested money is going. So the more of the money that's going into drilling the wells is going to give you those higher intangibles. So, and I'll give you an example. Our last deal that we did, we closed it in December. We ended up passing on a 95.6% intangible drilling cost, tax benefit to our investors. They got a 95% K1 loss. So on a $100,000 investment, they got a $95,000 loss. So let's say you make $500,000 a year, you invested $100,000 into that deal, got a $95,000 K1 loss. Your taxable income just went from $500,000 to $405,000. And depending on what tax bracket you're in, I mean, that can range anywhere from, $30,000 to $38,000 in actual dollars that you don't have to pay the IRS. So it's pretty substantial.
And is there any risk of recharacterization or, having to, as far as that tax break, any considerations down the road?
I would say, first of all, you need to make sure that the deal you're investing in is structured properly. You have to come in as a general partner with unlimited liability. And the tax code states that that is not considered a passive deal. And the other great thing, we're in real estate, typically to get the active losses, you have to materially participate. You don't that's not the case in oil and gas. You come in as a general partner and you take on unlimited liability, which we can talk more about later. It's really not quite as scary as it sounds, depending on how you invest. And then the only other thing that you might want to look at is the investment planning on exiting? Because if they are, you could potentially have recapture. Now, you have to make sure that the deal is exiting at less than the cost of it. So let's say it was a $100 million deal and there was a 95%, K1 loss. That means that you can't sell that for more than $5 million or you're going to have depreciation recapture. So we're very, very intentional about that. We want to deplete the majority of the oil and then exit, when we have that small amount left, because taxes are a big thing for us. So that just something worth, taking note of and being aware of.
Yeah. You spoke earlier about how there's the familiarity with investing in oil just because of your upbringing. And I think that's one of the, I would say, probably intimidating things about oil, because not everybody and every day. I mean, real estate is I think a lot more relevant and prevalent because we all live with a roof over our head.
Right.
And a lot of my investors, they do, if they're in real estate and they're real estate agents, a lot of times they invest in real estate because they know it, they feel comfortable with it. And you actually mentioned it's not as maybe as scary as it sounds. A lot of times it's like a diversification too, right? So not everybody's going all in on oil. But maybe address some of those potentially scary things, or just the high level of what makes oil and gas investing fundamentally different, and how does it fit into the big picture?
Yeah, I think probably the biggest thing that people are the most worried about is drilling a dry hole, right? It takes millions of dollars, upwards around $10 million to go out and drill a well. That's a generalization. You can have shallow, vertical wells that are much cheaper. You can have, longer horizontal wells that are much more expensive, but it's very expensive to drill. And if you pump millions of dollars into a well and there's no oil, the money is gone. You get the tax benefits regardless, but nobody wants to invest in something just for the tax benefits. You need to get your money back. I think what has changed so significantly with technology and everything else is when they introduced horizontal drilling and fracking here, a couple of decades ago. That really changed the landscape. And we like to drill in what I call tier 1 basins. So that's like the Permian Basin, the Bakken, these areas that people are probably pretty familiar with. If you're drilling a horizontal well in a tier 1 basin, your success rate's more than 90%. It's the likelihood of drilling a dry hole is almost non-existent. For me personally, I prefer horizontal wells over vertical wells. They are more expensive, but the success rate and the recovery rates of oil are significantly higher, although the cost is higher. So I prefer that. And really, I think A couple of other things worth looking at is if you're looking at investing in the deal, are you providing the funding for the whole project? Are you owning a small percentage of that deal, or is it all of it? I am really big on diversification. I do not like single well projects. I feel like you're putting all of your eggs in that one basket. I always want to root for the small guys, but I like drilling with companies like Continental Resources and EOG. These are really big, multi-billion dollar, many of them are publicly traded, and they're everybody likes to talk about skin in the game. They have almost all the skin in the game. That's their wells. If they're going to go plug $50 to $100 million into drilling some wells, I know that they have got the geology, to back up what they're going after. And so I love to come in and take a small percentage of that. So I think whenever you're looking at oil and gas, you need to kind of figure out what your financial goals are. Why are you assessing that? Are you doing it for the tax benefits, for the cash flow, for potential upside later? You need to figure out why you're wanting that, and then make sure that you find a deal that aligns with what you need and matches kind of your risk tolerance, because there are definitely some much riskier, higher potential oil and gas deals, but then there's also some kind of the not so exciting, more boring, but more solid deals. Obviously, nothing is ever guaranteed. And in the oil and gas space, there's two things that impact the outcome of these deals that no operator out there has control over. And that's the price of oil and how the wells perform when they come online. And I don't care if you're Exxon or the smallest operator out there, you have no control over either one of those things. So making sure that you are getting into a project that is able to address lower oil prices and things like that's just really important. And we could go down this rabbit hole for the next 5 hours.
Yeah, I'm sure you could, and obviously due diligence is everything, right? And what you're saying just is probably what the actual tax benefits and the reason why they exist is probably directly related to the risk that's involved, and just motivating investors to continue to take those risks. It's a lot really easy for us to look at the big oil companies and kind of snub our nose at how like rich they are, but I had an opportunity when oil prices were rising. I think it was in 2021. And they hit a pretty high peak there. I became really interested in looking like upstream, downstream, like the amount of understanding you need just to understand like what it takes from getting a drop of crude into the tank of your car is astounding, and the amount of risk that comes along. So what we see is the rich people kind of the success. And look, it sounds like to me there's way of assessing those risks, but what we don't see is like is the people who just they come up dry, and like the amount of risk that goes into play. But with that said, and speaking about risk, say we have someone who's really interested, they want to learn a little bit more. What are the factors and what can we expect for these opportunities to present as far as risk? And I don't imagine this is regulated in any way as far as what they have to give you. So it seems scary in that sense. So I'd love to hear a little bit more about like the risk and what people need to consider and what they should be looking for.
Yeah. Well, I would say that when you're assessing oil and gas, just like real estate, the operator and the location matter. That should be the very first thing that you're looking at. Who is drilling that well and where are they drilling it? Like I mentioned earlier, I like to drill in these tier 1 basin. These are basins that are proven to have oil reserves. And who's drilling it? What kind of experience do they have drilling wells? How many wells have they drilled? Have they ever drilled in that specific type of area and rock? Because drilling in the Permian is very different than drilling up in the Rockies in, Wyoming. I mean, it's completely different ball game, versus drilling, in the Anadarko in Oklahoma or the Bakken up in North Dakota. They're all very, very different. And so obviously, if we're going to participate with somebody like Exxon, I don't need to do background checks. I don't need to see, what kind of experience they have. I know what they can do. But if it's a smaller company, I am going to look at background checks. I am going to pull their well history. How many wells have they drilled? How many wells do they have actively online? Those things matter to me. You need to look at those two things. And I want to drill in Texas, where we know we've got proven reserves. I'm just not interested in if somebody said, hey, we're going to go drill a well. I'm trying to think of somebody, in the middle of North Carolina. I'm probably not going to be interested in that. Could there potentially be oil there? Sure. But there are no proven reserves that I'm aware of in that area. And I don't want to participate in that well. So I would say those are the first two things that are most important. The third is, what is the break-even price for their project? At what point does that project become unprofitable? And for a lot of smaller operators, it's like $60, $65. So 2025 was a tough year for a lot of smaller operators. A lot of them had to go offline. A lot of the major oil companies, they are profitable down to, $30, $40, much, much lower. They just have the economies of scale that you don't see with these smaller operators. So the break-even price.
Are you talking WTI?
Yep, WTI.
Obviously, and I know, but
No.
but I just wanted the listeners to understand when you say like 65 and
No, and sometimes I forget that everybody doesn't know all the things that I know, but United States oil is traded on the WTI. That's the West Texas Intermediary. A lot of people will look at Brent, but Brent is overseas. So here, American oil is the WTI. So that break-even price matters. That break-even price is a really big deal. So operator, location, and the break-even price. And then from there, you can break it down into a whole lot of, other things. There's different risks. And I look at, how many wells are they drilling? Are they vertical or horizontal? And we actually have a pretty good kind of a due diligence checklist that kind of goes through a lot of those things. When I'm assessing something, it's got to meet like this first, 5 criteria right off the bat. And then, once we get through that, if the answer is yes, then we can move on and go, okay, what does the rest of this look like?
It's interesting to me, like as we sit here, like I sit here and I'm psyched when WTI is going down. So sorry, but because obviously that's driving up a lot of like most of what we're doing, obviously. But it's funny to me on the other side of the country or down in Texas, people are loving it spikes because it adds to the bottom line. But to me, that adds to the risk. It's not just the idea that you have to find oil with these very expensive drilling projects, but you also have to maintain the price of oil has to maintain at a certain level for you to even be profitable.
That's that break-even price. If it's $40, then last year when oil dropped, even in January this year, we were down in the lower 50s. So it matters. If you're in a $65 break-even project, not only are you not making money, you could potentially be cutting checks every month to cover monthly operating expenses.
I remember like during the pandemic, it went below zero or something. Wasn't it like they were paying people to like take the oil?
It dropped. It was very, very quick and it rebounded. And it had to do with the contracts and the way that the contracts ended. We won't go down that rabbit hole, but it was
again. We're trying to be positive here. I'm sorry. I just went very negative, but I just remember. I guess my point by bringing that up was like it's very dynamic, right? Like, and it moves.
It is, but those daily movements don't affect these operators because they lock in contracts. They're not selling oil daily on the trade. They lock in, 30, 60-day contracts. So that regular movement, I didn't have any deals where the drop below zero impacted any of my income. It just didn't hit us at all. Our operators had those contracts locked in and it stayed down there so briefly. It wasn't a long-term deal.
Somebody else was losing money, but it wasn't you, maybe. Okay, so with that said, perfect time to shift gears to cash flow. So we've been talking a little bit about like the cost of break even. What does the cash flow look like for the investor, and just a little bit of high level input there?
Yeah. So I think this is also where oil and gas has the potential to really shine. I think with real estate, you invest, it's typically quarterly payments. And then eventually, typically you realize the biggest chunk of income when they exit the asset, 5 years down the road. What I like about oil, is that you invest and typically you get your money back faster. Obviously, the higher the oil price is, the faster you're going to get your money back. And so, we've been in a bear market for a couple of years, so the returns haven't been as high, but you're able to, recoup that money a little bit faster so you can redeploy it. And that's kind of my strategy, invest in oil, get the tax benefits, get the money back, and then redeploy it into real estate.
Interesting.
But the cash flow is good. And usually typically it's monthly. Every deal can be structured differently, but oil and gas income is typically monthly.
Yeah. Speaking of, pretty quick turnaround on some of the payments from a personal experience. I was surprised how quickly they couple of individuals, obviously not naming any names that got involved. How few 4 or 5 months after they already reaped the benefits of the tax investment, they're receiving payments, which I was really surprised. And the key factor here is one is you want to do your due diligence. You want to understand what you're investing in. You want to see how it fits into your overall picture. Basically understand, what it means for you, but you don't want to cut off your nose to spite your face. So like, you don't go in and just be like, oh my gosh, you have these tax benefits. The tax benefits are pennies on the dollar. The tax benefit is not going to pay for your investment. You have to make sure that first and foremost that the investment, it looks good, for the lack of a better way to put it.
Right.
So before we finish up here, I'd love to maybe and we talked a little bit about this, but is there any misconceptions that you'd like to speak to that people have about oil and gas investing?
I think probably one of the biggest ones that I've heard over this last couple of years is that electric vehicles and renewable energy is going to eliminate the need for oil and gas. There's been a big narrative around that in the media and everything else. And I think actually right now what's going on with the Strait of Hormuz and Iran has actually proven how very wrong that really is and how dependent we really still are on oil and gas. And I think what people don't realize is a lot of these renewables and even these electric vehicles need oil and gas to even be built. Tires are, you need petroleum products for that. They're all very dependent. So I don't think people realize that. People know that they think of oil and they think of gas in their cars, but oil is actually in just about every product. I mean, if you're on a computer or a cell phone right now, oil was needed to create that product. It's in plastics, it's in medical equipment, aspirin, asphalt. We need it for everything, for just about everything, cosmetics, you name it. So, and this is a really rough estimate, but 1 barrel of oil is about 42 gallons, and about a third of that barrel goes into creating gasoline for cars. Another third of that barrel goes into creating diesel and jet fuel, and the other third is used for more than 6,000 products that are used pretty much daily products. And so it's so much more than just gas in your car, and I don't think a lot of people realize that.
Yeah, and not to bring it up again, but it is actually one of the eye-opening. There was a scene in Landman where he taught, there's a classic scene where he drives the lawyer out and he sits there and he's like, the cement to get these windmills. And again, it really was, it's true. Like my dad was in plastics for years, and like plastics, cement, like all those things. There's so many things that it's kind of scary in a way, I guess, how much we rely on it. To me, like I don't think that anyone, if we could figure out a way to drive a car on water, like I think you'd figure it out. But like to me, like it is what it is for now, and we're very dependent on it.
Yeah.
Is there a way, like is that the breakdown you gave for WTI? Is that the way it is? Because I know that there's like different, if it's more sour, maybe there's like more of a percentage it goes towards this, and if there's, or is that too complicated for?
Well, there are a lot of different grades of oil. Like Venezuela produces a heavy crude, which there's not very many refineries in the world that can refine it. A lot of what we produce here in the United States is a light sweet crude. I think Asia uses like a medium grade crude. And I think what people don't realize is that we actually export a lot of what we produce, and we import a lot of what we use. We import, I think 60% of our oil that we import comes from Canada. Mexico is our second largest place that we import from. And a lot of our stuff is sent out. It's actually cheaper for us to import the type of oil we need than to refine the oil that we produce. And when you think about these different types of oil, think of it as like you can't turn around and take regular fuel for a car and put it in an airplane and expect it to work. You can't take diesel and put it in a regular. So these different grades have to be refined and processed different ways. And a lot of countries, they just use different types of oil. So hopefully that answered your question.
Yeah. No, I'm probably getting a little too much in the weeds. I just find it very fascinating, the whole idea that, refineries aren't all created equal. So, the idea that like there's certain oils we just can't refine. And at a certain point, the way that the oil industry has played itself out, for whatever reason, we have to send a lot of that oil out.
Yeah.
So great conversation. I'm like, I could talk with you about this forever, but I want to leave it at that for now. But I do want really quickly for you to provide to our listeners a way to stay in touch with you. It's my understanding you have a really cool newsletter that talks about oil if someone's really interested and wants to geek out on it. And it sounds like you may have a project coming up here too that you could just maybe mention at a high level.
Yeah, well, thanks for mentioning the newsletter. I spend a lot of time, building that out, but talking about, what's going on and kind of trying to figure out how to read between the lines and, what do these things that are happening really mean and what does that look like? And we are about to launch our next, diversified oil and gas fund. I'm super pumped about that. And so thank you for bringing that up.
Pumped. I see what you did there. Name of the company, places to sign up for this, and we'll include all this in our show notes.
Yeah, you can go to ironhorseenergyfunds.com. We have a website and get some information there. And I'm on LinkedIn. I'm not big on social media, but I do have a website also. It's CourtneyMoeller.com. And, you can reach out and check out our Iron Horse Energy Funds website. We've got a really great oil and gas report that you can sign up for, and it'll get you connected and involved in all the things. So.
Excellent. Well, thanks so much, Courtney. I really appreciate you joining us today. This was super informative. I know our listeners are going to love it. And thanks for everyone who listened today. And until next time, have a great day.
Don't forget to follow the Agent of Wealth on the platform you listen from and leave us a review of the show. We're currently accepting new clients, and if you'd like to schedule a one-on-one consultation with our advisors, please do so at bautisfinancial.com/call.
Thank you for listening to the Agent of Wealth podcast. Click the subscribe button below to be notified when new episodes become available. The information covered represents the views and opinions of the guests and does not necessarily represent the views or opinions of Bautis Financial. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional financial planning and investment advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investments and financial planning.